Alberto, when you look actually at what we're hearing from China, I mean, is it manipulating its currency? Even if they were even if the U.S. were to change the way it looks at it, it'd be a very hard case to sell.
I think actually that they have reacted very mildly compared to the amount of sanctions that has been imposed from the United States. China could devalue its currency further. We think investors have been particularly fixated with the 7.0 level of dollar yuan. We think it could go slightly higher than that, but we don't expect a very strong move, especially before midterm elections. And here I think China is playing the long game, whereby they don't want to boost Trump support by making a very hard retaliation against the sanctions. So we don't think the game is over. We think there is more to go.
Wolfango, what's your take on China? You can see basically, China speed rolling some of the policies to make sure that the flailing market is kept abreast. But do you worry about the Chinese economy and fundamentals?
No, not particularly. Obviously, it very much will depend on this tussle with the United States. But on the other way around, no, we're not particularly concerned about that. And I agree with Alberto that here China is for the long term, So that is the leverage they have over Trump. Trump has got electoral calendar. He has got electoral appointments to take into account. He's got a Congress to manage. That is not something Chinese leaders have to take into account. So they play for the long game there.
And now for the surveillance dumb question of the morning, I'll do that with Alberto Gallo of Algebris. Alberto, does China have a fixed income market? Do they have tradable debt?
We've seen, obviously there is a domestic market in renminbi, but we've seen a growth in the local currency corporate debt, which China rightly wants to develop to be able to outsource lending from its banks. As you see the Chinese economy today, there's probably between $1 and $1.5 trillion in non-performing loans across the banks. And as you know, the asset management companies, so the bad banks, have been established. But they want to be prepared for the next crisis by having bonds and the bond market take part of those losses, which is a smart idea. It's what the U.S. has been doing and the reason why the U.S. recovered faster from the crisis. So it's growing. And there's also the hard currency market, which actually has been losing a lot of points in the last few weeks. We think it's become attractive. The yields are over 10% in some of the high-yield Chinese names now.
What's interesting, Alberto, is equity strategists will tell us the Chinese equity market's not a normal equity market. I would assume in a bond market you need to have price discovery. How do you discover price within a communist regime? In both the hard currency and the local currency market, what we have seen is that because in the Chinese economy there is a large amount of savings, you have over $20 trillion of savings, there tends to be a lot of demand for domestic assets, whether it's from the national team or from private investors that have a lot of savings to invest. So normally the Chinese market is very expensive compared to the risks, compared to the leverage in the economy, in the private sector. And despite some of the backstops from the government, which have become a little bit smaller. But in the last few months, we have seen a big repricing with many of the high-yield bonds losing 10% or more. And therefore, now we have a situation where some of the private sector companies in China are priced for recession, which never happened in the last few years. So we think it's time to consider a position there.